Hi, Joe Lopresti here with the latest Arlington Wealth Management Proactive Strategy Update for Friday, December 1st. Since our last update, the PAS market model gave a new signal, a buy signal. We refer to it as a confirmed up signal. And this signal indicates that the 3-month correction, August, September, and October, has completed, and the next up leg in the bull market that started a year ago, a little over a year ago, in October of 2022, that bull market is getting a new life, and the next up leg in that market has begun. The signal came just about 2 weeks ago on Monday, November 20th, and we took a couple of actions since that time. The first, generally moving to get more invested in the market, reducing cash holdings and hedges. Second, to reallocate into a fresh group of asset classes that appear to be leading the charge during this latest upswing in the market. Let's move on to looking at our proactive asset allocation dashboard, and you can see the change shows up right here in the confirming signal box that confirmed up on November 20th. If we look at the indicators below the signal arrows, we could see one positive change here in the long-term momentum in the core indicators. Turned back to positive after spending 1 month in neutral status. Let's take a quick look at that one. So here you can see the long-term momentum indicator. This is for the global stock index, not the S&P 500, but a globally based indicator. And we could see the 3-month correction here, and now the recovery has flipped this back into positive status after spending 1 month in neutral. We don't like to necessarily compare this to other periods, but if you look at, for example, this period when we had a correction after a bottom and then spend 1 or 2 months in neutral status back to positive, and you can see in that particular case there was some nice follow through to the upside. We don't want to necessarily translate that into this particular signal, but we do see some opportunity developing in a little bit more of a short-term window. I'll get to that in a minute. But the key takeaway is positive momentum is good, and you can see, the momentum, one of the momentum calculations down here, that this is moving in pretty good fashion to the upside. Now we have the cash comparison charts, which are positive as well, and those are really the two indicators that speak to the cycle in the market, and one of the main reasons why we have a confirmed up signal. The universe trend indicator, which is a little different type of indicator, it helps us look a little more underneath the surface of the market. That continues to be negative, and it is a concern, and we'll come back to that a little bit later in this video. Tactical indicators are both in the neutral zone after hitting the low risk oversold level about a month ago. So here, for example, our overbought oversold indicator, we could see that this hit overbought at the end of July, just before the correction began, and corrected pretty uniformly, I would say, right down to the lower end of the channel. And so it went full circle to the oversold level. And now we're seeing that start to recover, and we're right on top of that bull trend average, which is the midway point between the overbought and oversold level for the bull market. So this is the channel that we expect the market to trade in as long as it continues in an upward trend and a typical bull cycle. So here you can see that confirmed up signal came in right in here, and that indicates that we're getting the next up leg of the bull cycle, and I would also say is very much in line with strong seasonal tendencies at this time of the year now through the early part of 2024. And we're past that weaker season in the market, which tends to be in the middle part of the year, say late summer, early fall, generally speaking, and the correction came just like clockwork during that time. And as I mentioned earlier, a confirmed up signal in the PAS market model was designed to take two actions. The first is to invest cash that was built up from previous tactical selling. The second is to reallocate positions into the asset classes identified as potential leaders by our asset class ranking system during this cycle. So we've taken that action at this point, and in a first step, we reduced cash allocation to about, say, 30 to 35% to become more invested. And we mentioned in the flash alert, by the way, that we sent out when the signal happened, that if the confirming indicators continue to gain strength, we plan to reduce cash allocations further. And it looks like that's happening. So we may be bringing cash allocations down even more to get more invested in this upleg that seems to be developing in the market. As far as the areas, the market segments that we're invested in, the new asset class selections for the PAS ETF and stock models include a lot of technology. Semiconductors and the software industries are heavily represented, as is just the broader technology sector. The home building industry group will also have representation, and there are smaller allocations in selected emerging countries and a couple of thematic groups. For example, we bought for the first time a fund that invests in cryptocurrencies, and it's been part of our asset class ranking system for a couple of years now, but it's never been ranked high at the point of a buy signal. It is this time, so we took a small position in that area or segment of the market. Other strategies outside of PAS invest in different asset classes according to their objectives. All are reducing cash holdings and moving into new positions that are, generally speaking, in line with this market cycle and expected to provide higher returns. As I mentioned earlier, seasonality cycles seem to be working like clockwork. The market corrected late summer, early fall. That's typically the weaker season. It bottomed in October. October's known to have bottoms and reversals. Did it last year, did it again this year. Rebounded in November. So barring a shock that could throw the seasonal trends off track, the market could move higher through the early part of next year, at least through the end of this year, maybe into the early part of next year. S&P 500 could challenge the all-time high, which is above 4,800. We're currently right around that 46-ish hundred area. It hit that high about 2 years ago. It was right at the beginning of 2022. And a push above 5,000 certainly is not out of the question. So that correction that developed in the late summer, early fall period shook a lot of risk out of the market, set the stage for a new upleg that's developing. And that's a positive development. But we want to be aware that confirmed up signals are not a sure bet. There are a couple of concerns that we continue to have that we want to monitor. The first is that the breadth of the market, or the amount of participation, just is still very weak. It's been the case for quite some time. It's been a concern. Doesn't mean we can't get shorter tactical opportunities develop in the market, and it appears like we're having one now, but that's probably going to hold back this signal from developing into a lengthy uptrend. Second, economic models continue to be negative. We've been beating that drum for quite some time now. However, every economic cycle has different lead times, and the latest numbers we got, which are now through the end of October, just continue to point a lackluster economic environment, which generally isn't conducive for a solid long-term uptrend in stocks. So there's three things I want to look at to show the point of the lackluster breadth in the market. And the first is our 210-day rising indicator. We sent out a flash alert at the beginning of October because this gave a signal that, and we call it a warning, that the breadth in the market, the number of stocks that have an upward sloping 210-day average, really deteriorated during that correction. August, September, October, you could see the big drop from, say, 74%, came all the way down to 44% at its low. And even though the market has recovered quite a bit since then, we're not seeing much recovery at all in this percentage. So still hanging out below 50%. The significance of that is times in the past when it's dropped below 50%, we've seen a lot of volatility and continued downward movement in the market take place. It did it here last year. It did it during COVID, did it during in 2018 and other cycles. So this one could still start to gain some strength and kind of tag along with the market uptrend. We're hoping that that's the case. But as of right now, we're not seeing any strength develop in this very important indicator. So we're going to continue to monitor this one. And, if we see it deteriorate further to the downside, it may be a sign that this year-end rally is going to get cut short. But if it starts to pick up some steam and particularly get above that 50% level and start to accelerate from there, could be a sign that this buy signal is going to develop into something more than just a short-term opportunity. So it'll be one of the key things that we monitor to try to determine, how long we want to stick with this signal and how strong of a signal that we believe is developing. The next area we're concerned about is the universe trend indicator. Again, this is a breadth indicator. There's over 4,000 stocks in this global all-cap universe that we're monitoring. And we're not seeing a lot of strength develop here either. So the logarithmic chart is still very close to its low. It hit a low of 50% in October. Right now it's just a little bit above that. So no meaningful pickup in the percent of stocks that are showing positive trends globally. And that's concerning, right? We want to see a new market rally with a lot of participation, not narrow participation. Right now, we have to call this one a very narrowly driven market with a lot of the mega cap tech companies continuing to lead the way, and that's just not healthy in our view. The traditional version is a little bit closer to a reversal up, but still the July high was up here at 54%, and we're hanging at 46%. So the market, if we look at the market overall, it's very close to the July high, or at least approaching that level, but we're not seeing the number of stocks with positive trends approach the level that it was at the end of July. So again, a concern here on this indicator. And finally, and in a similar vein, the global stock index in our asset class ranking system. The version of the ranking system we're looking at here has 104 asset classes. The one that we use for our asset class selection has over 250 asset classes. But with this one, we're looking at the global stock index out of 104 is ranked 39, which is high for the broadest universe in the entire ranking system. Typically, we see this hanging out right near the middle, right around 50. It doesn't tend to stray too far away from that midpoint of 52. But for some reason, we're seeing this highly ranked. And what that tells us is not a lot of stocks, or I should say in this case, not a lot of asset classes, sectors, country markets, etc., that are outperforming that broad global stock index. Now, why would that be? Well, even though it's broad and it has the most stocks in it, it's still market capitalization weighted, meaning the biggest companies have the most significant influence on that index, and therefore those mega cap companies are strong and are showing up as strong in this index, but not a lot of other things are outperforming this index. So along with the negative breadth, or I should say unimpressive breadth at this point, the economic model continues to be flashing a recession warning. We've been talking about this for quite some time, but can't really let this lull us to sleep. Every economic cycle has different lead times. If we look at the last major recession back here in 2008, you could see how long it took for that to develop after these warnings occurred well beforehand. And if you let that particular period lull you to sleep, then you miss the importance of why we have these models, and that is to be a forewarning of a coming recession. We still believe that's developing. In fact, the red line, which is the leading index, is at a new low for the cycle, and you just typically don't see that happen until you're in recession in terms of it bottoming, or you're about to enter the recession. The long leading one oftentimes does start to recover early, and you can see it is recovering here, but still very deep into recession, and that has sometimes upwards of a 2-year lead time. So recovery, after a recession might start sometime down the road, but it's that recession in between now and then that could have some significant damage to the stock market that we're concerned about. So in summary, things seem to be shaping up for a pretty good year end. It may be into the early part of next year. It's possible it develops even farther than that. We'll watch some of our key indicators. For now, we set our sights on a short-term opportunity, and if things improve from a breadth standpoint or even an economic model standpoint, then we could extend our investment horizons into intermediate and long-term. But right now, with those two concerns continuing to be there, not a lot of participation in the market, the economy is still very lackluster. We think that we're setting up now for a short-term opportunity. We can't really look much beyond the early part of next year with this signal at this point. We'll continue to monitor everything closely, and of course, we'll be reporting to you as we see changes or evolvements take place with this particular market cycle. Thanks very much for watching. Enjoy your weekend.